It's good to see everyone join this very riveting and interesting and engaging tax session today. But just to quickly introduce myself, my name's Luke, and I'm a member relationship manager here at Collective. And Collective, I mean, you can essentially think of us as your all-in-one back office financial platform. And we'll set up your business. We'll set up your LLC if that needs doing. We'll make an S corp election for you, handle your payroll, bookkeeping, tax filings on an ongoing basis, and we'll just provide generalized support, throughout the year. But today we actually have a session that we like to call Tax Tuesday, and essentially it's an AMA session. It's an Ask Me Anything session, surrounding taxes and S corps, and best, financial business practices, or things like that. So please feel free to ask me, whatever's on your mind. And, keep in mind that, though, before I say that, the tax code is very complicated, especially the U.S. tax code. So it's important to, don't consider this information, official tax advice. Don't consider it legal advice or anything like that. This is just information. So before you act on any of this, it's a good idea, to speak to a CPA, speak to a tax attorney, or some sort of licensed professional before you make any moves on this. But now that we've got that out of the way, we might as well go ahead and get started on some of this tax stuff. Okay, here's a good question. Let's say I have a loss from my business. Let's say, and by a loss, I'm assuming this person means more expenses than they have in income. Assuming that I have a loss in my business, how can I take advantage of that? And I'm assuming, how do you take advantage of a loss in a tax context? How does that save you on taxes? And really what happens, at least with an S corp anyway, it might work a little bit differently for other business entities and whatnot, but with an S corp, you can actually, so let's say that, in 2024, that your business has a loss. It has more expenses than it does income. So let's say that last year, maybe you personally contributed money to the business because you're building it up, and you spent more than you make. You just spent more on business expenses than you had, income that you've received in income. That means that you have a loss for 2024. So, for example, you can actually, excuse me, got a little choked up there. But with that loss, under certain circumstances, you can actually carry that forward and deduct that loss from future years of income. So let's say that you have a loss of $10,000 in 2024. But let's say in 2025, you have, a net income of $10,000. Like you end up, you don't have a loss in 2025. You end up making a positive amount in net income. As long as you have enough basis in your business, which essentially means as long as you have enough money that you've invested into the business, then you can write off or you can deduct last year's $10,000 loss from this year's $10,000 income, which means it kind of washes out, and you don't, because you had a loss last year, you don't pay any tax on that 10 grand of income that you had, income tax on the 10 grand of income that you have this year. So it's pretty interesting how that works out. What happens if we miss tax deadlines? Well, nothing fun, that's for sure. And really, what mainly happens at the beginning, what mainly happens when you miss tax deadlines is penalties and interest. When you don't file your taxes on time, penalties and interest are usually a part of the equation now. And what happens is there's two types of main penalties that you should think about in this situation. There are failure to pay penalties, which means you're just late on your tax payments. But there's also failure to file penalties, which means that you owe penalties, of course, for not filing your tax return. And the failure to file penalties are much higher than the failure to pay penalties. So essentially, so let's say that you're not ready to file your return by the due date, which for a personal return is April 15th. Then in order to save yourself the late filing penalties, you can file an extension. And that, ensures that if you don't file your return by the deadline, the April 15th deadline, and as long as you file that extension, you won't be charged the failure to file penalties, which are pretty steep and expensive. However, if you don't pay your tax, though, you'll still, or what you owe, you'll still be charged the failure to pay penalty. Filing an extension doesn't get rid of the failure to pay penalty. So if you have to file an extension this year, for, let's say it's April 15th, 2025, and you're just not ready to file your return, at least file an extension. That'll prevent, a lot of the penalties. And also, if you can, make a payment to the IRS. Send in an estimation on how much you think you might owe. Because as long as you get that payment in either on April 15th or before it, you can also prevent failure to pay penalties. And even if you pay a little bit over, when you do go and file your return, it'll calculate the exact tax you owe. And if you've overpaid, then you should get a refund back. It's not a big deal. I haven't filed my taxes from last year. Am I in trouble this year? Well, I mean, it kind of depends on where you are in the process, how long you've been late, essentially. But it seems like if you haven't filed taxes last year, probably the worst thing that's happening right now are penalties and interest are accruing on your tax balances if you haven't paid anything. So that's the worst thing that's happening likely right now. Now, however, eventually, when you don't file your return, the IRS can actually file for you. They can file on your behalf, and it's called a substitute for return. So they're called SFRs, substitute for returns. And it's essentially when the IRS files on your behalf and they don't give you any sort of deductions or favorable deductions or anything like that. So usually when they do an SFR, a substitute for return, you owe more than you do in actuality because they're not giving you any deductions or anything like that. And then once they file that substitute for return, a balance will be posted on your account. Whatever that substitute for return says you owe. So let's say that you're not filing a return, they file for you, and let's say they claim that you owe them like $50,000. That $50,000 is now on your account, under the IRS account saying that you owe it. And eventually, and then they'll start sending you notices saying, hey, sir or madam, you owe us money. We need you to arrange payment arrangements. We need you to arrange payment arrangements. And they'll send you several notices. But eventually they'll send you a notice that says, if you don't arrange payment with us, like some sort of payment plan, if you don't pay in full, then we're going to start levying your bank account. We're going to start garnishing your wages. And since we've sent you all these notices, we now have the legal right to do that. So once you get to that point, it ain't fun. And it's a good idea to reach out to the IRS as soon as possible and get an arrangement set up, because then they can start taking money right out of your bank account. They can start attaching a garnishment right onto your wages. And they can I've seen situations where they've taken a majority of someone's wages and it was hard for them to meet their living expenses. So it's a good idea to just file as soon as you can. And if you can't file an extension and pay as much as you can. It's my first year filing as a freelancer. How should I file accordingly? Well, if you're asking at this point in the year, you probably are going to file a Schedule C. And a Schedule C is just essentially a form that goes along with your personal tax return. And a Schedule C is really just a profit and loss statement for your business. It shows like the total amount of money, or it should show the total amount of money that you made that year. And you'll also report the total amount of business expenses that you had that year. So then you'll have your net income, which is simply just your total amount of money minus your expenses. And you'll report that net income on your Schedule C in your personal return. And that's how you report the stuff in your personal return. And if you, like, let's say if you have some sort of tax software like TurboTax or something like that, you can do this online. This is a really good question. I made an LLC the tail end of last year. Do I have to file taxes for it? That completely depends on if you've made income or not. If that LLC made income, then yes, you need to file taxes for it. But filing taxes for an LLC is the exact same way as if you file taxes if you didn't have an LLC. It's done on your Schedule C on your personal return. The LLC is a business entity. So in certain situations, it provides you with legal asset protection. It separates your personal assets from your business assets. But in a tax standpoint, an LLC, the tax situation for an LLC is essentially exactly the same as a tax situation for a sole proprietorship. They're both disregarded entities, and it doesn't really matter. So if you have an LLC at the tail end of the year, if that LLC had income, then you'll file it on your Schedule C, your personal return. But notice that I said that it had income. If it made no income, or if it had a loss, you're actually not required to file a Schedule C just because you have an LLC. If that LLC did not make any income or have any business activity, or if you had a loss, you don't have to file any. You don't have to file anything on your federal tax return for that LLC. A lot of people don't realize that. So if you don't want to mess with it, like if you have a loss and you don't want to mess with reporting it, then you don't have to. Is it possible to become an S Corp before I file for taxes this year? Yes, technically it is possible. Now it's complicated because this would be at this point time of the year, like to do it for 2024, this would be a late S Corp election, a very late S Corp election. And you need special forms that you need to send in. And so usually it's a good idea to go to a tax attorney or a CPA to get something like that done. What's the easiest way to understand an S Corp? Well, the easiest way to understand an S Corp is to understand, I guess, really how we're taxed in the US is a good start. And there are two types of taxes that you can think about when you're thinking about US taxation. One are income taxes, and that's what most people think of when they think of taxes. It's just essentially, a tax rate that's charged on your income, and they're marginal rates. So different chunks of your income are charged different tax rates. However, there's also the self-employment tax. That's a completely separate tax rate. Another word for it is the payroll tax, or even another word for it is a Social Security and Medicare tax. And it's a 15.3% flat tax rate. That's the Social Security, that's the self-employment tax. Those are the two types of taxes. The types of taxes that are relevant for an S Corp, though, is the self-employment tax, the Social Security and the Medicare tax. Before you become an S Corp, like when you're just a sole proprietorship or an LLC or something like that, a huge chunk of your earnings are subject to the self-employment tax. So let's say, you make, let's say that you make your net income is $100,000 and you don't have an S Corp. You're just an LLC or you're just a sole proprietorship. That full $100,000, theoretically, is subject to that 15.3% self-employment tax. That's just how it works. With an S Corp, though, it works differently. With an S Corp, you now become an employee of your own company. You literally become a W-2 employee of your own entity, of your own LLC. So now that you're an employee, you'll pay yourself a salary. You'll pay yourself a wage, just like, or your business will pay yourself a wage, just like you'd receive if you work for someone else, like as a W-2 employee. But the cool thing about S Corps, though, is that the only amount or sort of the only portion of your earnings that's subject to the self-employment tax is your salary amount. So, for example, like how I mentioned earlier, let's say that you make $100,000, but let's also assume that your salary with an S corp is $40,000. Something like that. Let's just assume that that's a reasonable salary for someone making that much money. With an S corp, that first $40,000 is the only chunk of your earnings that's subject to the self-employment tax. The other $60,000 is not. Those are considered distributions to yourself, and they're just no longer subject to the self-employment tax any longer. So, in a situation like that, someone making around 100 grand, the S corp would save this hypothetical person, I want to say around $9,000. Let me see. Yes, it would save them $9,180. So once you reach a certain income level, it can become pretty advantageous to become an S corp. I've been filing my own taxes for years as a self-employed hairstylist. I'm starting to get overwhelmed doing it myself and keeping up. What should my first step be? I keep struggling trying to budget in a CPA. Ooh, the first step is to schedule a call with us. And what you can do is go to collective.com. Send us a message here on Instagram or LinkedIn or social media and ask to schedule a call. And you can meet with one of our advisors. And they can see if, an S corp might be in your best interest, if collective might be a good place for you, to handle all your stuff. And no pressure, by the way. If not, it's no big deal. If you don't need to be an S corp, then, or you don't need to, be with collective, then we'll give you some referrals. We'll point you in the right direction. But I would suggest for you and for anyone else listening that if you think an S corp might be in your best interest, or if you are ready to kind of outsource all this annoying tax stuff, then schedule a call with us, and we'd love to have a conversation. But that is actually all the time that I have left today for Tax Tuesday. I've actually got to go help some collective members. But it was a blast, like it is every week, and I will see everyone next week for another Tax Tuesday.